Well, it's not really my fault, and I'm not going to take all the blame for it, but I want to start today with a couple of recession-related stories because that's starting to creep its way back into the things we're hearing about these days. Then I'm going to finish things off with a couple of housing updates. But first off, JPMorgan, they're now estimating that there is a 35% chance of the U.S. entering a recession by the end of this year. And that's now gone up from about 25% that they had at the beginning of last month. And they've revised this in response to, of course, the most recent U.S. news that's indicated a greater than expected drop in labor demand and some initial signs of job cuts. JPMorgan economists, led by Bruce Kasman, they explained the U.S. news hints at a sharper than expected weakening in labor demand and early signs of labor shedding. The team here is maintaining a 45% chance of recession occurring by the second half of 2025. They've also adjusted their outlook on interest rates. They're now seeing just a 30% probability that the Fed will keep rates higher for longer, and that's down from a 50-50 chance a couple of months ago. We are seeing U.S. inflation pressures easing. JPMorgan is anticipating the Fed is going to cut interest rates by 0.5 point in September and then again in November. That seems to be becoming the consensus these days. And this update follows a similar move by Goldman Sachs. They recently raised their recession probability for the next year to 25%. The economists here noted that if a U.S. global recession does occur, it's likely going to lead to a sharp and immediate easing by central banks. In contrast now to what JPMorgan is saying, according to Daniel Iveson, he's the Group Chief Investment Officer of PIMCO. He says the U.S. economy might avoid a recession, but its worsening fiscal situation is leading PIMCO to invest more in foreign government debt. He says that recent weak economic data that led to the stock sell-off that we've seen recently and a rally in U.S. government bonds, it reflects increased recession concerns. Despite this, though, he believes the economy could achieve a soft landing. He says specifically, we do think the market has probably gotten a little bit ahead of itself in terms of pricing in central bank cuts. Now, he still anticipates only a 25 basis point cut by the Fed in September, barring any major geopolitical or market disruptions. And that, of course, is in contrast to, like I mentioned, a lot of analysts are now believing that the Fed will cut by 50 basis points next month. I've even seen cuts projections bigger than that. Now, last week's rally in U.S. Treasuries, that was also driven by rising geopolitical tensions. Particularly, we're looking right now at Iran's threats of retaliation against Israel and the U.S. That's really heating things up out there. The sell-off in the market, that's widened the credit spreads, which makes a lower quality corporate debt less attractive to these big money investors. And Iveson noted that the floating rate, lower quality credit markets, particularly private direct lending, is the area where you see most complacency at the moment. PIMCO is focusing on safer parts of the corporate debt market. They're also responding to client concerns about the U.S.'s fiscal health by increasing investments in both foreign bonds, and they're noting countries with lower deficits like Australia, New Zealand, the U.K., and Canada. And Iveson says that the U.S. fiscal picture is currently dire but manageable, though there could be future challenges if debt servicing costs become a political issue. The U.S. manufacturing sector is booming again, and this is largely in part thanks to some key legislation that was passed back in 2021 and 22. We have seen a dramatic rise in manufacturing construction spending driven by the Infrastructure Investment and Jobs Act, the Inflation Reduction Act, and the CHIPS Act. So we've seen aerospace, defense spending. They're also seeing some major growth due to global geopolitical tensions. This has been pushing defense spending now to records high. I recommend that you have a look at the Harvest Industrial Leaders Income ETF. The ticker is HIND, trades on the TSX. And this fund's industrial portfolio, it includes leading companies in the aerospace and defense, the industrial machinery, and more. HIND uses an active covered call strategy, so this gives investors higher monthly income. If you're looking to benefit from the resurgence in this U.S. manufacturing, the semiconductor boom, the strong aerospace and defense sector, HIND is your chance. You can learn more today by visiting harvestetfs.com. I will put a link for this fund in the description of this video. The poll question in this week's Pulse newsletter is, with the U.S. unemployment rate rising to 4.3% in July, do you think this signals deeper economic issues, or is it just a temporary fluctuation? We are almost a week now since that poll was put up. I'm a bit surprised by the way it's going so far. I will be publishing the final results in this weekend's edition. If you're not subscribed already to Pulse, go ahead and give it a try. My goal there is to provide sort of a tight, informative recap to the most important news stories of the week. I'm sure you'll find it valuable. Click on the QR code here to join the crowd. In our first housing-related story today, Toronto home sales were down in July, even after the second most recent cut by the Bank of Canada. We have seen slightly reduced mortgage costs, but buyers are maintaining a hesitancy to get into the markets, and this has led to an increase in property listings, and particularly condos. Active listings are at their highest now since 2008-2009 financial crisis. So we're going back a long way there. According to the Toronto Regional Real Estate Board, they reported a seasonally adjusted 1.7% decline in home sales from June to July. And this is now the fifth decline in 6 months. So we're definitely seeing a trend there. When I look at the contrast to that, the number of homes for sale still remains high. It's nearly 24,000 available properties across the Toronto region. Now, Karen Yolevsky, the Chief Operating Officer at Royal LePage Real Estate Services, noted it's not putting pressure on buyers to get in now. She believes buyers are waiting for home prices actually to start rising before they're making purchases. The home price index for the region, $1,089,800 in July. That is a very slight increase of 0.1% from June, but it is 5% lower than what we saw last year. There has been an increase in showings for single-family homes, might suggest there's potential future sales, but condos are certainly less popular. There are currently nearly 9,000 active condo listings. This is a record high. Many new units are being completed this year, and buyers are feeling less of an urgency to purchase. Now, the real estate board is expecting that sales will pick up in the fall as mortgage costs decrease with the further interest rate cuts that we're expecting. Following along with our housing theme here, rents across Canada are still increasing, but they're now at the slowest pace in the last 2.5 years. So that's some good news there. And this is according to a report by rentals.ca and Urbanation. In July, the national average asking rent for all residential properties was $2,201, and that is a 5.9% rise from last year. This is the slowest year-over-year growth that we've seen now in the past 31 months. Now, notably in the report here, Ontario and British Columbia saw rent decreases, with Vancouver, Toronto seeing declines of 7% and 5% respectively, and this is due to a new influx of available condo units. When we look at the flip side to that, in Halifax, they saw an 18.2% increase in rents. And some of the prairie cities like Saskatoon, Edmonton, Regina also saw double-digit growth. Smaller markets near Calgary, Lloydminster, Lethbridge, where I reported here, they saw year-over-year rent increases of 20%. Lattice commented here, secondary markets are really speeding up where primaries are kind of mellowing out. From a provincial perspective, Saskatchewan currently has the fastest growing rental prices in the country, an annual increase of 22.2% for purpose-built houses and condominium apartments. That said, the average rent in Saskatchewan is still 38% lower than the national average. So even though it's that much cheaper to live in Saskatchewan, the rate of increase is really speeding up there. We're also seeing similar trends in Alberta, Atlantic Canada, with 15% annual rent increases. British Columbia saw a 2% decrease. Over the past few weeks, we've seen some pretty disappointing earnings reports from some of the major tech companies out there, but the gig economy really seems to be emerging as a bright spot here. Companies like Uber, DoorDash, Instacart, Grubhub, they've all surpassed expectations, and they're reporting strong growth and strong consumer demands for rides and deliveries. Uber CEO highlighted the company's resilience during the economic downturns. He says, while our customers tend to be higher income, we're not seeing any softness or trading down across any income cohort. Gig economy companies are really benefiting now from seeing more and more people seeking this gig work when the labor market is slow. That can lower the cost for some consumers in these areas. Unlike major players like Apple, Amazon, Microsoft, the gig economy firms haven't faced the same market hype that we've seen recently. That makes them a little bit less susceptible to the current market reversals that we're seeing. On the delivery side now, consumer habits have proven stronger, more ingrained than expected. Analysts agree that ride-sharing food delivery companies have become more entrenched in consumers' budget, and they are remaining strong even in this post-pandemic era. That's everything for today. Thanks so much for watching. We'll see you in the next video.